and good evening, everyone. I am Mansi Ganekar, working in the Investor Education Department of NISM. As you may be aware, NISM is a capacity building initiative of SEBI, and we at NISM conduct a wide range of activities at various levels with the objective of improving quality standards in the securities markets. At NISM, we work in 5 broad areas: long and short term academic programs, certifications for market intermediaries, e learning programs, training programs for working professionals and academia, and various investor education initiatives. We introduced a series on the foundations of financial planning comprising 5 episodes, scheduled on every Thursday of January 2026. The previous episode was conducted by Mr. Shailendra Kumar, in which he focused on the asset allocation. And today we present the 4th episode titled Goal Setting and Planning by Ms. Renu Maheshwari. Now I would like to briefly introduce Ms. Maheshwari ma'am. Ms. Renu Maheshwari is Tamil Nadu's first individual SEBI registered investment advisor and a certified financial planner. She is the chairperson of AREA and leads the commission-free financial planning and investment management firm FinScholars based in Chennai since 2013. So I would request Renu Maheshwari ma'am to begin with the session.
Sure. Thank you, Mansi. Always a pleasure to interact with the investors and the citizens seeking to get more clarification on their personal finance through your channel. So good afternoon, friends. This is our, as Mansi has already mentioned, we're going to talk about goal setting and planning today. You already have gone through 3 sessions earlier, which gave you the basics of everything else, including asset allocation. And then we finally come to goals planning. The basics of goals planning is very simple. Money has got a purpose. And the purpose of money is to fulfill your life goals. We always say money cannot buy you happiness, but money can make you awfully comfortable when you are unhappy in life. And that's the purpose of money. What does it mean? It means it should be there, available to you at the time when you need it. Not 10 years after that, or 5 years after that, or 2 years before that, because that doesn't solve the purpose of money. It's a tool through which you achieve things in life that you want to. Money is not the end goal. Because money is not the end goal and money is a tool or the methodology through which you achieve your end goals, goal planning becomes one of the most important aspects in your personal finance. So today we will learn a little about that. Of course, it's a little bit of a technical subject, but we have made it very simple so that you get the gist of it and you understand how you need to go about it. And as an investor, what should you be looking out for? So when you go and talk to your advisor, you are yourself aware of what you want to expect out of your consulting or advising exercise. So as we said, turning learning into actionable investment strategies. As Mansi mentioned, we are part of ARIA, Association of Registered Investment Advisors. I'm the current chairperson as well. And we have tied up, NISM and ARIA has tied up to be able to reach out to masses through series of webinars. This is one of the series. In today's webinar of these, I'll make the presentation in around 40 to 45 minutes. We will have a couple of 3 or 4 quizzes in between. In case you have an important question, you can put it on Q&A, and I'm sure Sahil or Mansi will help us coordinate that. At the end of the session, we will definitely take up all the questions that you would have presented over here. So today's agenda, as you can see on the screen, is what is smart investment goals? How do we differentiate between short-term goals versus long-term goal? What should be the criteria? One very basic thing, how do you calculate future value? And it's going to be a very, very basic formula, which you probably learned in 8th or 10th standard in your schools and college, during your schooling, and you can easily use it. And then how do you align this asset allocation, which you did last time, to the timelines that you want to achieve through your goals planning, and of course, emergency fund, etc. So let's first of all understand what smart investment goals, SMART. So smart, the word itself means a whole lot, but over here it's got a good abbreviation worked out. SMART is specific. S stands for specific. M stands for measurable. A stands for achievable. R stands for relevant. And T stands for time bound. SMART goals, clear, actionable strategy through the planning. How do we use every single word over here? Specific. Your financial goal needs to be specific for you to be able to plan. So, for example, I want to have money, enough money for my child's higher education. Great. How much money will you need for that? So, what is the second question then? What do you think he would like to do when he grows up? Now, when your child is 4 years old and you're planning that you should have enough money for his higher education when he's 17 or 19, that's more than 1.5 decades. How do you know what your child would like to do? So then how can you be specific? And that's what I'm going to tell you through these small examples, that how do you figure that out? It's very important for you to be able to have the specific amount, because otherwise, how do you set a target and how do you achieve it? But how do you create that specificity? Suppose you say that, okay, maybe he'll go for a medical, suppose. So the medical will cost, say, 1 crore in today's terms. What will it cost 10, 15 years down the road? And then you say, what if he doesn't want to be a doctor? He just wants to be, he wants to do some alternative course. So then you think about, okay, what would be the approximate amount if he goes for some approximate course as of today? And you say it can work out something around 25 to 40 lakhs. Now you have a wide range of 25 lakhs to 1 crore of your target goal. And that's the specifics we are talking about. So although we are talking about specific, but there will always be a range of specific depending on the time frame. Suppose you were deciding this goal, which was only 3 years or 2 years down the road, that you want to buy a house, which is about, say, 3 crores right now, and you want to buy the house 2 years down the road. You can be more specific about it. But of course, when the goal is long term, the specificity would be much lesser than that. Nevertheless, it still gives you a parameter. So like I spoke about in the previous thing about education goal, anything from 25 lakhs to 1 crore. So how do you work? At least I should have at least 25 lakhs come what may.
Hello,
But I may
ma'am.
need 1 crore. Yeah, we were talking about specific. So the specificity has to be there, but don't get too perturbed if you don't have the exact answer. A range can also work. And once you have the range, your advisor will also help you figure out little more of the nuances. Whatever you measure or do a specific or create a specific target, preferably do it in present day terms, because that's the number which will be available to you. You would know it. Like, for example, I said, maybe my child's education as of date will cost me 50 lakh of rupees. I go by that number. On that 50 lakhs, then I'll apply the inflation number, etc., and do the calculation. We'll come to that a little later. So have that specific target. Second is measurable. What does it mean? It means that I want to have a great life. What does it mean in terms of financial planning? Or I want to buy a very nice house. What does a very nice mean? Very nice has got no meaning in terms of planning. So it should be a measurable target. What is your very nice house? Three bedroom apartment, or a six bedroom duplex house, or a studio apartment in a very nice locality. Whatever is your definition of that nice or great education, define it properly, which can be measured objectively, and then have the specific amount that you will need for investment, for reaching that financial goal. Second is achievable. That means I have a job of 12 lakhs per annum and I want to buy a 5 crore rupee property 5 years down the road or 6 years down the road. Not an achievable target. So have a realistic target. And you may say that, okay, how come you are talking about that? But we get so many people who would have had a long list of things that they want to do, but there is no visibility of how will they make the money. So investment can do a lot of good for you. It can create a lot of wealth for you, but it's not the magic wand where money can be created out of thin air. So have an achievable goal, which seems achievable. Now, how do you define achievable? Again, that is something your financial planner or your advisor can help you with. They will be able to work it out that, okay, today you have a 12 lakhs per annum job, but your salary will increase over a period of time with the current career path. Although the price of the asset may also increase. So housing price, education price, that may also go up with inflation. But your investments will also give you return. So now you see what are the three moving factors over here. Apart from your specific and measurable goal, there are three other things. That is inflation number. That is how the prices may go up in the ecosystem. Second is return number. That is how much will your investment yield you. And the third one is how much more you will be able to save in future and how much more you will be able to earn and save and invest. So these three are variable numbers. That is why we always say that there is no plan which is etched in rock. Plans are defined today, recalibrated at least annually, and then work towards the goal. You cannot have one financial goal which is going to do for you for the rest of your life. It doesn't work like that. Sometimes that once doing one plan, at the beginning of your life, or sometime, 35 years or 40 years or even 45 years, and thinking that's going to do all that will take care of all your other needs, can be more disastrous than not having a plan, because it can give you a false sense of security, and it can become a popo, what we call plan on paper only. See, all this planning that we are doing, we just spoke about three factors right now: specific, measurable, achievable. And we just spoke about three numbers that are going into these calculations. And do you see that these are all presumptive numbers? These are all assumptions. When we talk about corporate planning, we talk about economic growth, etc., etc. And with all the experts sitting over there, they can't predict for next 3 years and 5 years. And here we are trying to project for next 30 years, 40 years, and 50 years. Can you imagine that? That is the reason why it's very important for you to be able to understand that all these assumption numbers should be recalibrated constantly for you to be able to have specific achievement job, for you to be able to achieve something out of your financial exercise that you do so painstakingly. Third one is relevant. That means each objective should have a strategy of how you will achieve it. And how will you devise that strategy? By ascertaining the time frame. Let's just take the education goal again. We will stick with this one goal so that there is a better understanding. Let's talk about an education goal for which we assume that we will need 50 lakhs of rupees, say 10 years down the road. Now, here, in terms of relevance, you need to now align this particular financial goal that you need the money after 10 years. If I need the money after 10 years, my risk tolerance goes up. Right? So the intermittent movements of market doesn't matter. Yesterday, when Trump announced he will take the Greenland, come what may, markets corrected. Second day, when the statement is kind of taken aback, markets come back. Those volatilities don't matter to you when you're going to need the money after 10 years. So that time horizon has to be ascertained. If you have to accumulate 50 lakhs uh, compounded for inflation, say it becomes 1 crore after 10 years, you have a 10-year time frame. So that's the longer the time frame, the bigger, more is your risk tolerance, and of course, you will be able to achieve bigger goals. But what you need to do is now you need to avoid distractions, you concentrate on what matters most. So different kind of factors come in when depending upon the time horizon, risk tolerance, and then based on that, you decide the portfolio strategy as well. Fifth is time bound, like we spoke just now. What is the time that you will take to, I'm so sorry about this. Yeah. What's the time that it will take to reach the financial goal? So SMART goal framework is a very important framework for you to have right at the beginning, for you to be able to have an actionable investment goal setting. We move to the next step of the same strategy with an example, what I was talking about, that in this, so these are just the examples of the same thing that I was talking about, that if you need a down payment, say in 3 years down the road, then how much money you should invest. I have taken out this picture because you see this. It represents it very well. This is what we call timeline. And in this timeline, if this is time zero, and this is the time when we aim to achieve our financial goal of buying this house, how do we do it? Right? So today, the amount is zero. 3 years down the road, if this person wants to buy a house and he needs, say, 2 lakh of rupees, this is the time frame or the timeline on which he needs to accumulate that. Year 0, year 1, year 2, and year 3. So gradually at every step of the time, the money needs to grow for you to be able to achieve the growth, achieve the goals at the time of year 3. Now, the second aspect what we are talking about is what should be the return target? How much money you should be able to earn when you want to achieve that financial goal? And as much as we would like to achieve the maximum, trust me, that doesn't happen. What we can do is achieve the maximum within the given risk constraints or given the risk profile. I'll just go to these common pitfalls and then explain you the short term, long term, and that's where more clarification will come to you. The common pitfalls or common common mistakes that we end up making is, as we spoke about, is vague goals, unrealistic targets, not reassessing and ignoring the market volatility, or paying too much attention to the market volatility. Both the things are very can be disastrous. So look at your if you have to do in practice, if you have to do a goals analysis or you have to fix the goals in your life. Say you are 35 years old today, you have a children's education goal, you have a housing goal, and you have a retirement goal. Let's look at 3 goals at one point in time, and they will be there. Minimum 3 goals are always there. The first goal which will come is buying a house. But buying a house is something where you can be flexible. If you don't have enough money, then instead of a 2 crore house, you can settle down for a 1.5 crore or 1 crore or even less. You can even take housing loan. Same, there's a second goal of a higher education. That's a second goal in the timeline. But when the goal comes, you will have, you can either fund it yourself or you can also take education loan. So that is another, whereas in the first goal, you had 3 ways you could have managed that first financial goal by manipulating 3 factors. That is the amount spent, um, then your housing loan, and deciding upon the timeline also. Instead of after 3 years, you can even buy it after 4 years or 2 years. Whereas education goal has to be done at that time. So the time factor is something you cannot play with. You will definitely need that certain amount of money if the child wants to, if your child is has targeted for something and is able to achieve that, you would definitely like to fund it at that point in time. The only other support that you have here is that you can go for education loan in case your planning has gone little wrong, or in case it's a little above than your affordable amount. The third goal in the same series that we were talking about was a retirement. Now, the problem is retirement goal is the last goal to be achieved. It's end of your working life usually. Seems too far away. Feels most one of the most when you are in your 20s and 30s, it seems like the most unimportant goal. Oh, we're seen tomorrow, kal dekhenge na, pata nahi kitne time tak zinda rahenge. All of that kind of stuff, when people are young, they think of all of those things. The problem is when you retire, at that time, there is no other resource to fall back on if you've gone wrong with your planning or your investments. So, what do you need? You need a holistic planning. We're talking about goal setting, etc., and on specific goals as well. Sorry. But what you actually need is you need a whole life planning, a proper goal setting exercise for the whole life. So, what happens is you consider one, if I go back to the same timeline, you consider this line as your life. Within this life, there are times when you can keep putting the money into the timeline. That is your savings going into it. And then there are times when you will take the money out. Number one, for house. Number two, for education. Number three, some wedding, some function. Maybe intermittently, some bit of medical issues, and constantly you keep putting money into this investment, and then usually it ends with retirement when you take the whole money out, or you take move the whole money into retirement kind of a different kind of portfolio from where the money constantly keeps coming out and there is no inflow into it. So you see, your whole life is interspersed with inflows, outflows, and initially more inflows, then in between lot of outflows and lot of inflows, and then at the end very little inflows or no inflows and all outflows. This is what your life needs to be geared up for, and this is what we do when we talk about holistic planning, and that's why it becomes very important. So usually we all and most of the advisors would encourage holistic planning rather than one individual goal planning, because as easy as goal planning may seem like, it can be a very futile exercise if you have not done the whole life planning. These are the common pitfalls, and I've also told you the fixes in general for when you plan for your life. Now I'm coming to specifics of short-term, long-term goals, medium-term goals, but I'm going to talk about how do you, when we define these short-term goals, long-term goals, and how do we prioritize them? That's how do we do all these three things together. This is what, a little bit of an explanation for you, and why do we want to define it. So short-term goal is something we usually say anything from 1 year to 3 years. Below your 1 year, of course, and up to 3 years is what we consider short term. 3 to 5 years is medium term. 5+ is always a long term. What happens in a short term goal? In a short term goals portfolio, what you should be sure of, even if you do not earn money on it, you should be very sure that you don't lose your capital. So capital preservation is the biggest criteria for a short-term goal. For example, if I have to buy a house 3 years down the road and I'll need down payment of say 20 lakhs for that. As of today, I should start, 2.5 to 3 years before the goal is already, before I need to spend the money, that money should start coming into my safe account. That doesn't mean savings account. There are other tools as well, like liquid funds, short-term debt funds, which are also equally safe, or bank fixed deposit, depending on the situation in the ecosystem, usually the advisor recommends the best possible option. There was a time liquid funds were giving 13%, while banks were giving 9% return in fixed deposits. So those kind of options is something which you can get from your advisor. But this is what is the priority for short-term goals. Very often we have seen, and trust me, we see it very often in our advisory practice, when people come to us, they would have taken a bet which looks sure shot. Why do people take bet? Because they think it's going to happen, right? Because we all assumed 6 months back that gold will go up, and gold is going up. But what if tomorrow something happens and gold stops going up or gold crashes because it has gone up so much? And you needed that money for, say, 1 year down the road. Today is January 26. Maybe I need that money, say, in January 27 or January 28. And in between, if that particular asset class goes down, then what do I do? Sometimes I have seen it's 3 years, 2.5, 3 years down the road, and someone would have given them a bet, oh, these derivatives will make you a lot of money, etc., etc. So a lot of people get into the trap. I've seen people buying real estate kind of things. Oh, I'm booking this apartment and I'll sell it after 2 years because that's when I need the money for my child's education. Not realizing that these are all high risk investments and should not be used as a tool to keep your money for short term. These are the short ways for financial failure. So, for a short term goal, and that to an essential goal, make sure your money is in either fixed deposit or in a liquid fund or a short term debt fund. There is no other option where you can keep the money, where you should keep the money for your short term goal. Capital preservation, low risk, high liquidity. These are the three things you need for the money for your short term financial goals. For all your long term financial goals, to the contrary, you can take more risk. For example, if the same goal was needed, say, you need the money after 6 years, you can take a bet right now in spite of equity market being so volatile and so many geopolitical risks arising in the market. We are very sure that Indian economy is at a great place and we will grow. In 5 to 6 years time, we will definitely make a lot of good money. And then the right thing to do will be to create an aggressive portfolio where you will have high level of equity or even sometimes even real estate depending on the on the overall financial situation. But for a 5 year time, real estate is a bad idea. Real estate is always a good idea only for 20 plus years financial goal, not below that. For 5 years plus, equity is the best option. So you can easily invest over there and not worry about the short term volatilities. This way, your money can grow. You can give the factor of time, advantage of time to for your money to grow. Uh, how do you prioritize? Based on the urgency, based on the timing, based on risk tolerance, based on how much capital you need to allocate, and then, of course, diversification and rebalancing. Sahil, would you like to give those two questions now? So friends, try to answer this question. It will give you an idea of how much you have grasped the concept. As simple as it may sound, but it's a very useful concept for managing your personal finances. An investor targets a timeline of approximately 24 months for a specific financial need according to the source material, which investment trade should be prioritized. For 24 months, A, preservation, B, aggressive growth, C, high risk equity, D, illiquid assets. No, there is no result. It's just a question.
Okay, so I will let you know what are the results. So 77% of the attendees have selected A option, 10% have selected B option, then 9% have selected C option, whereas 4% have selected the D option.
Okay, so the 77% A option is the right one. All of you who have given the answer as B, this is what I was saying. For a target of timeline of approximately 24 months, that is 2 years, you should not be looking for aggressive growth. That's not the right approach. High risk equity allocation for less than 2 months, whatever may be your risk profile, whatever your risk profile number or your money behavioral number says, but that's where your objective financial goal is the most important aspect of your goal planning and your investment plan. That is the timeline of your financial goal. So high risk equity allocation is also a wrong answer. And asset like illiquid assets is definitely. Sahil, something is not, why is it saying incorrect, etc.? Something is not right with that whole answer of yours. Anyway, A is the correct answer. Let's move on to the second one.
Okay.
Okay, this is the one which you give your answers and keep it to yourself and decide upon it when we go to the next topic. What is the recommended size of an emergency fund relative to an individual's monthly expenses? That means how much money should you have in a 100% safe instrument for your emergency funds? We will take it up. We will check that answer after I do the next part of the presentation. Sahil, can you take this poll away now? We will check the answer later on.
Done.
So keep this question in mind, and this is the question which we wanted to give you in advance so that you start applying once we go through the slides. I'm just giving you this concept of future value of goals because this is one of the most important factors in the whole of financial planning. You have all learned compound interest in your school timing and school time, not even college, school time, right? What was the compound interest formula? There was one was simple interest, right? What was that? That is simple interest is equal to interest multiplied interest rate divided by 100 multiplied by number of years, right? And then you add that to the principal and that becomes your amount. What was the compound interest formula? What was the formula for compound interest? Can anyone put it in the chat or Q&A? Anywhere. What was the compound interest formula that we all learned? Yes, I see Anup saying amount is equal to P into 1 plus R by 100 raised to the power N. Perfect. How many of you think you know this formula well? If you want to solve your life's financial planning problems, it is this one formula. This holds the key to everything. If you understand this formula well, you will be able to solve at least, if not 100%, 60 to 70% of your planning problems. That is, amount is equal to principal multiplied by 1 plus rate by 100 raised to the power N or 100. Can you all see the screen of Q&A which I have posted here? Please say a thumbs up or something like that in your chat and I'll be able to figure it out. Sahil, can you see the screen of Q&A also on my screen?
No,
No.
ma'am.
No? Okay.
You only see the time value of mini slide.
Okay. So I will say this way. Future value is your nothing else but the compound amount formula. This future value is amount of your compound interest is equal to principal multiplied by 1 plus rate raised to the power time. This is the formula for future value, or this is also the formula for amount. Very simple formula, right? This is the formula when we were talking about if suppose inflation is say 5%. How much will be your future value? What will be the cost of 50 lakhs of rupees of expenses today if the rate of inflation was 5% after 10 years? then this amount will be equal to what will be the present value or what will be the principal here? 50 lakhs. Multiplied by 1 plus what would be the rate over here? 5 divided by 100 raised to the power 10. And if you solve the equation, you will have the form value for how much would be your amount after 10 years that you will need for investment. So you got one answer that this is the amount that I'll need after 10 years for investment. Now I say, I know this amount that I'll need after 10 years, I'll need this amount if the rate of inflation is 5%. What should I invest for that today? What do you need to know? You need to know the present value of that. But now you use the same formula of compound interest, and where in that from that equation you are trying to find the value of principal. So this principal or present value will be equal to future value divided by 1 plus rate raised to the power n. What is the difference over here? The difference is this rate is now not rate of inflation, but this is your rate of return. So if your rate of inflation was 5% and your rate of return is 10%, this will get discounted by 10%, and this present value amount will be lot less than 50 lakhs. And that is where we say the formulae are, one is you can understand it from compound interest concept, but the other easier way is you can go to Excel, and in Excel, if you go to formula, click on formula and then say present value, future value, they'll be able to give you all the values over there, all the formulae over there. You just have to punch in your numbers and you will get the answer. This is one reason you see when I put this formula and this formula together. That is where you see why it is important to have a return which is much higher than the rate of inflation. Because here, rate of inflation is the compounding factor where your present cost of 50 lakhs is going to go up, say probably up to 1 crore in 10 years time frame. Whereas here, the rate of return is the discounting factor, and your 1 crore can come down much below 50 lakhs over here to up to 30 lakhs or so. And that's the reason why we need to have this return higher than this. Interest rates is the R factor, of course, over here. And this is in the same equation. If I want to calculate R, then that's the interest rate calculation. So time value of money has got only these three factors. The fourth factor is discounting periods in a year. That means, if you have intermittent compounding, that if the compounding is happening on annual or semi-annual basis, this becomes a little more mathematical. You should just understand the concept and maybe use Excel and do trial and error, or use ask your advisor to help you, or there are plenty of calculators available online. So this is your basic understanding of how do you use the formula to be able to. These are all the examples that I was talking to you. These are the formula that you use in general to achieve to figure out the numbers objectively for your financial goals. I want to add one thing over here. As simple as these numbers and this calculation may sound, and it's pretty simple, if you use Excel, all the more simple. The problem happens because in real life, there is a lot of complication of at what intervals that money will go in and at what intervals the money will come out. And that's the reason for financial planning. On a routine basis also, sometimes we end up, not sometimes, most of the time we create our own softwares, like we in our office have our own software which we use so that all the answers are correct and all complications are built into the system. So the same very simple formula of compound interest becomes a complicated affair when we apply it to the practical lifetime of an individual. Now, these are the risk profiles which we do by time frame. Short term will have preservation, medium term can be a balanced portfolio, long term can be a aggressive portfolio, and then you align them to the timeline and to improve goal success. I'll take your question and answers to be able to, and those while explaining those questions, your answers will explain the things. My answers will explain the concepts better than my just going through those slides in too much of a great detail. So we spoke about this thing, short-term lower risk assets, long-term growth-oriented assets. Review and rebalance, it's the most important aspect. Like I said earlier also, right in the beginning, no plan is etched in rock. Keep reviewing it and then rebalancing it. That means taking the corrective action over there. Emergency fund and insurance is something, it's one of the financial goals that we want to talk about very specifically. And that is that before making any investment, before doing anything else, the first thing that you should do is create an emergency fund. This emergency fund can be 3 to 6 months of your expenses if you are salary class. If you work in contracts and you invest, you earn in spurts, then it can be different. Your advisor will be able to help you out depending on the frequency of your earnings. But 3 to 6 months is a general norm that you should have that money in your safe and absolutely liquid asset class, for example, bank savings account or a liquid fund or even cash for that matter. So this is the first thing to do. Emergency fund helps you tremendously. It helps you not getting into the trap of debt trap. It helps you because when you need money suddenly, you can dip into this fund and then replenish it later on rather than going for personal loan, etc. Or even worse, breaking your long-term investment or stopping your long-term investment strategies. So this is a very, very important thing. Second thing is you should protect your downside. That is, you should have your life insurance and health insurance in place. These are the risk measurement. That means you first secure yourself and then think about growing. Sometimes people don't secure the downside and just keep running for the upside, and any downsides takes away their wealth and hurts the financial life badly. So in any of these goal setting and full financial planning process of your life, first thing is create the emergency fund, number one. Number two, protect your downside. Life insurance, if there is a liability, if someone is financially dependent on you, and buy only term life insurance, do not buy any other insurance, endowment policy or money back policies. They are not the right tool for you. They are good tools for the industry and the intermediaries, but not great for the investor. Insurance is not an investment tool. Insurance is a tool of risk protection. So use pure risk protection tools like term life insurance, health insurance, vehicle insurance, your householder's policy if you have your own house, and reduce your downside. Rather, build a safety net for yourself. That is the first aspect. Create the emergency fund and then start investing. In investing, asset allocation needs to be around your SMART goals, match around your time horizon, align the allocation, align the amounts, and then make the investments and manage it. Needless to say, when you need help with financial planning, you should reach out to the unbiased advisor, because only then you will be able to get advice which is specific to you rather than centered around what product will make the advisor more money. So reach out to an unbiased advisor. You can SEBI registered investment advisors are the unbiased fiduciary advisors in the ecosystem who are registered and licensed with SEBI. How do you find them? You can find them at SEBI's website. You can also go to ARIA's website and there's a member directory. You can find them there as well. So you also have this list on BSE's site. There are 3 places which are authentic places to find a registered investment advisor. Okay, plenty of people gave the numbers for, I'm seeing it only now, for the formula for अच्छा सुमित जी हिंदी में, हाँ ठीक है, आपके जो प्रश्न होंगे वो मैं हिंदी में उत्तर दे दूंगी। निसम ने मुझे इंग्लिश का कहा था इस बार, इसलिए इंग्लिश में पूरा बोला है। आपका Sahil, can you just take over one moment? This is I have.
Also, I can see a few questions related to certificates and webinar recording of earlier episodes. So you can visit NISM YouTube channel and NISM website as well for the past financial planning series episodes. The certificate will be provided to you within 3 to 4 working days.
Hello.
Yes, ma'am. You're audible.
Yes, I'm very sorry. This was a very high level phone. I had to take it from the government. So I had to take that phone. Okay, let's take your questions, please, audience. Okay. CA intermediate CFP. Vyom, this is a question we will take separately for guidance. You can probably ask Sahil to connect us. We'll be able to do it for you. We also run RIA clinics, so someone can help you over there as well. Then, what are the best investment assets online opportunities in all over the world to generate wealth as soon as possible? The lead, stay out of it. Just don't look for excitement in wealth. This is the way you can get into trouble, most troubles, as much troubles as possible. I'm just dealing with a scam issue right now. Just look at registered people, go to straightforward people, and then make investments with registered advisors and registered intermediaries only. Uh, Anonymous attendee, financial goals need to be assessed, reassessed on regular basis so that goal may be achieved on or before the time. Yes, this is something which I said, review, reassess, recalibrate constantly. Japesh says, isn't this about a moving target? How we plan or make a goal will vary. Absolutely. And that is where I said, you create a plan today, you go back after a month, after a year, again, relook at the plans. And that's how you keep recalibrating and reorganizing. It doesn't mean that you don't target today and you don't plan for it today, because with no plan, you will be in a much worse situation. What level of risk tolerance is suitable for short-term goal? Absolutely low level. Your assets should be in 100% safe places like a savings account or a liquid fund. Dr. Ritika is asking, how can we decide what is the correct time to choose rebalancing of assets rather than reallocation of assets? See, the best thing is look at it at a 6 month interval, but definitely at an annual interval, and then do the rebalancing. So automatically you will stay in good places. What, for example, if after a year when you see and your equity has gone up, say from 60% to 70%, reduce 10% of it and move into other asset classes. That's the way to rebalance. It also means sometimes you need help with the forecasting part, and that's where professionals can help you. But a year is a good interval. Formula for future value during the downs. Rajesh is asking, during the downsides of market, what will be the definition for long term or short term for building the comprehensive assets? See, downsliding of the market, etc., is a part and parcel. These are called volatilities. Bear market, bull market, these are all volatilities. You are not a trader. For you, when you are investing, just invest constantly, regularly, and start taking your money out from the market at least 3 years before your financial goal comes close to you. Stay simple, stay disciplined, you will make great money. Okay, future. It would be good if you would have been able to apply this learning in your personal financial planning. Also, what lessons have you been able to learn from experience which could have been managed better on hindsight? Okay, Koshi, now I think um, I'll come to that at the end because that can go on. For what mistakes I have made, I made mistakes in my life which I could learn from, and then make sure that when I'm advising, my clients don't make mistakes. And the mistakes, one major mistake I'll tell you right away. It was 2001 when the markets, my few of my assets had gone up like crazy. And I did not book the profits saying that, okay, I'm gonna save, I'll book profits after 1 year because then I'm gonna save money in taxes. After a year, the asset prices had gone down to, I think, 20% of the original. Yeah, that share price was 2000, which came down to almost to 135, 155 or so after 9/11. So that was the one of the biggest experiences in my life, and I learned practically how to manage assets and not get perturbed with the market. And if I would have held on, I would not have lost so much money. But yes, I did book some losses over there, and that was my biggest lesson in life. It took 7 more years for the particular stock to go up at that level. For SMART goals, would you not even mention the concept of asset allocation? Asset allocation was taken up in the previous series, a previous episode of the series, and that is the reason I have not spoken about asset allocation in details today. Asset allocation is the single most important factor for returns, as per experts. 90% of your returns come because of asset allocation. Because of asset allocation, your gains, your alpha goes way too much. It was not the subject matter of today. It was the previous episode in which we spoke about it. Can we send the PPT? This is up to Sahil. Sahil, you please take a call on that. Koshi says extreme events like global financial crisis, COVID have shown that even 6 months of funds have proved insufficient. Do you have any specific advice? Yes. The specific advice is COVID and World War II kind of things don't happen that often. Global financial crisis, etc., is something which is these are the things which happen, and that's the reason asset allocation is what works. So one is emergency fund, post emergency fund, then you have other funds which are available to you, which may not be into 100% safe instruments, but at least you don't lose your principal over there. So asset allocation overall, for individuals, we never recommend 100% asset allocation in equity. And this is one of the major reasons. And that's why everyone talks about asset allocation, that 90% of the returns come from asset allocation, because it creates a resilient portfolio. When you have a resilient portfolio, then during all these crisis times, even when your portfolio comes down, you can hold on to it, and you are able to actually even invest more during those times and make better money. So Bharti, for software, for risk profiling, you have Syntonic in the market. For asset allocation, I don't know, there are lots of financial planning tools available, but that becomes very technical. Asset allocation is something I'll never hand over to a software. Tracking the investments, you have InvestWell, you have mProfit, you can also do it on CAMS. Coach, in order to become a financial planning professional, which certifications? CFP is very good for knowledge. NISM 10A, 10B is the one which you will need for getting the license, RIA license. And then you need the RIA license to become a registered financial planning professional and registered investment advisor. How to find RIA near us? I have given you, this thing is already on display. Please go on to the ARIA website, go to SEBI's website, and you'll be able to find these lists over there. How we invest in stock market as a Muslim? I think what you are asking is that because you will need Sharia portfolios. Few of the AMCs had Sharia portfolios in between, but then they had a dispute about first layer of Sharia, or first layer of compliance or second layer of compliance. So I suggest you find some portfolio manager or RIA who are creating Sharia portfolios, and they'll be able to help you. How can you become an RIA? Dilip, please, Sahil, please take his number and connect him to us. We will put him on to a RIA clinic where he can help explore his pathway. Dilip Singh, please drop in a mail to NISM and they will connect you to us. Or you can also go to ARIA website and click on RIA clinics over there and send in an inquiry. someone will connect with you and tell you the next RIA clinic to be held. You will get all your information there. A 53-year-old, don't go into too much of safe investment and just wondering about beating inflation. Have a balanced portfolio, take help of an advisor. Sorry, because you all cannot see the question. R.S. Sundar has said, thank you, ma'am. I'm 53 years old. Can I safely invest in RBI FRCB bonds and beat inflation? And that's where I'm saying you have to take equity. Don't depend on the bonds alone. Otherwise, it's not just inflation, it's the growth, lifestyles, everything, So you should take up some exposure in equity as well. Take help of good retirement advisors and you'll be able to do that. Kishore wants to register as an RIA. Please, Kishore, again, go to ARIA. You would have received the answer. Write a mail to NISM. They'll forward it to us as well. Chatterjee is asking any template available to prepare financial planning. You can try and find a lot of stuff online, but my advice will always be, see, I told you right in the beginning, the whole planning is not a big deal. Planning is just calculation. Planning is dependent on your assumptive numbers. That is what are these presumptive numbers? Number one is your inflation rate, return rate, life expectancy, amount that you will need in future. Everything is presumptive number, assumption. And that is where you need a proper advisor who can guide you through the iterations of these presumptive numbers. And that's the reason this template can be a good starting point, but don't rely upon that. The answer for the second quiz was 3 to 6 months. You would have gotten it by now, Mandal. Okay, PPT, that's Sahil. What would be the strategy to invest in mutual fund for large, medium, small, and flexi cap for a time period of 5 to 7 years? See, the strategy, like I said, will depend so much on your goals. I can't say that right away because I have no other information about you. The simplest thing is invest in index funds and you will still make decent money. Kaushal Yadav wants to ask about RD for emergency fund. That's a perfect way to keep it. Once you have that emergency fund, keep it in a FD or even in a liquid fund where you can use it at any time. For Sundar is asking about retirement. He wants to save 10,000 per month till 7 years from now and safeguard the capital and interest. Sundar, you are 53 years old. You want to retire. Please connect with a good retirement advisor. Don't go with this a piecemeal basis online advice. It will not take you to places. And because of safety, you will miss out on the growth opportunities and may have an underfunded retirement. Okay, then software application for an investment advisor is a different question. CAGR formula, okay. Rahul, this is something which we'll have to take it separately because I don't think we can explain a technical formula now in this time. Why the equity participants are low in India? Because we don't have the equity culture in India. Financial markets became formalized only in 2000s in India. It's not even one generation, and that's the reason, but it's increasing and it will stay on. How to decide if we have to change the asset allocation? I have answered that question. Look at it on an annual basis, and you will need to have some bit of a asset level forecasting for which you need an expert to talk to. Do we review and modify investment to reach goal? Yes, all the while, like I said, on an annual basis. Harsh Modi is asking, can there be a possibility of partnership collaboration between RIA and MFD, as I want to recommend only those products which are just like an RIA. Harsh, please attend the RIA clinic. You will get answers to that. There are possibilities. There are ways out that you can do that. Vyom is asking, he's a CS intermediate student planning to transition into certification and appreciate the guidance. Again, Vyom, CFP is it's a separate subject matter that we can talk about. You can probably drop in a mail to my inquiry box and you will get enough information from our office. But yes, this is one of the most valuable certificates. Srinivas is asking what should be the time frame for revisiting and revising investments. 1 year, I said. Then Advait is saying, if I have started an SIP in large and mid cap fund, how can you rebalance? And if started SWP from balance, don't do SWP from balanced advantage fund is a sometimes, a lot of times rather, a mis-selling. You are not able to get the upside of equity or the debt either. So Advait, your questions are a little technical and they will need to be looked into with your portfolio. I cannot give you an answer offline, online like this. Rajiv, can you elaborate on how much I invest in my goal setting, for example, earning 5,000, how much we invest in RD? No, Rajiv, this is a very personalized thing. We need more details to be able to give you that kind of information. As a guaranteed return, is investment in bank deposit a right decision for long term? No. For short term, it's all right. For emergency funds, it's good, but FD and RD is not a good long term fund decision. CFA versus CFP for stepping into wealth management, MBA plus CFP to work out. Neeraj, again, get on to RIA clinic or connect with me personally. There are different things which CFP adds to your portfolio, your knowledge, and CFA trains. Both of them train you in different manners. Depends on what part of the wealth management you want to get into. Fund management, CFA. Financial planning, CFP. Sundar, again, I have given you the recommendation. It doesn't, don't run after safest alone, get the right advice, otherwise your retirement will be not funded enough. How can I connect with Sahil sir regarding my issue? Sahil, do you have a email ID or where people can send you questions and you can forward them?
Yes,
Or
ma'am. I
otherwise,
have dropped my email ID in chat section, so they
yeah,
can mail me
please.
there.
So, audience, if you need any other answer, you can drop the mail over there to the email ID that Sahil is dropping for you. Please have a look over there and drop in your question for all the other inquiries that I've been mentioning. How to identify your risk profile for setting short-term and long-term goal. Shivam, risk profiling is a little bit of a technical exercise which consists of psychometric tests and profiling. Your banker can do it, your financial advisor can do it. Just by identifying, it's probably not the best way to do it, just like that. Is there a general number to become financially independent? Well, you should be able to live off that passive money for the rest of your life, and that's what is the general number. How to invest in copper, uranium, metals through mutual funds? No, there are no mutual funds for metals, except you can have some fund houses. There are no ETFs for metals right now, except for gold and silver. There are mutual funds which invest in the companies who are mining into copper and uranium. These are more of commodity bets. I wouldn't really look at it as a mutual fund product. Which fund to recommend in such volatile market conditions, and is ETF on gold and silver good? Markets are volatile most number of years and they give return probably equal or less number of years. Volatility is part and parcel of the market. It's not the fund, it's the asset class. It's not the asset class, it's your financial life. So all the recommendations will be based on your financial goals, whether it's ETF, gold, etc., etc. It has to be around your own portfolio plan, which will be around your own life. Ayush is asking, where should we put our money for emergency fund? Yeah, all in a good fund houses, liquid fund, and maybe keep some bit in bank FD as well. Liquid funds are not giving extraordinarily high money right now. So bank FD is also good. Debashish is asking, what's the view on investment on precious metals? So gold, silver is we consider in precious metals. Copper, aluminum is a different thing. These are commodity tradings. I do not do trade tips anyways, but definitely not on commodities. Gold and silver is a different ball game. Gold is an international backup currency, and that's the reason it's going up. I will not be giving trade forecasts over here. I shared a webinar registration link to my friend. When she opened, she can't be able to. Okay, that's something you please write down to Sahil, and he'll address this question about the link not working. How will
Hello, ma'am.
financial planning work for people in 50s? Absolutely, it'll work. You just need to connect with the financial planner, and he'll tell you. Connect with the registered investment advisor. They'll be able to take care of your needs.
Hello,
Platforms
ma'am.
like that. Yes, I
Sorry
think,
to interrupt
yeah,
because we are already past the time and
I know. Yes,
we have other means small session means
yes.
in this meeting only. So are we
Okay.
good
Yeah.
to end the session?
Yes, absolutely. I think most of the questions are also done, so we can go ahead and wind this.
Okay, so just wanted to say thank you as we are done with our fourth episode of Foundation of Financial Planning series. We would like to express our sincere gratitude to our speaker, that is you, Miss Renu Maheshwari ma'am, for sharing her time and knowledge with us. Also, we request all the attendees to join us again for the next fifth and last episode of Financial Planning series for January month, which is scheduled on the 29th January 2026, and the topic will be related to case studies and practical application, and the session will be conducted by Mr. Amit Kukureja sir. Also, thank you to attendees as well for joining us today. So before leaving, I would like to request all the attendees to stay in for a few more minutes as we have with us Miss Srishti Khare ma'am, and she will going to discuss about the NISM FPSB financial planning course. So stay tuned in for a few more minutes. Thank you.
Thank you,
Okay.
Sahil. Thank you, Renu
Yes.
ma'am, for
My
such
pleasure.
an engaging session. Ma'am, I would request you to stop sharing this. Thank you, ma'am.
It's done, right?
Yes, ma'am.
Yes.
Good evening, everyone. So I'm here to discuss about our program PGPFP that we launched with FPSB India. I heard many questions about CFP program. So this program we are floating in collaboration with FPSB India. So first of all, about NISM, it's having a 72-acre campus at Patalganga with its state-of-art infrastructure. We are having 1,000 plus alumni in the security market ecosystem, and we are research partner with Ministry of Finance and SEBI. This program we are floating with FPSB India, which is recognized across 28 territories globally, and it is having 223,700 CFP professional worldwide. However, in India, we are just having 2,800 professionals, so there is a strong growth trajectory in this field. This program is a highly credible program with a career advancement in the financial planning sector. I'll brief you about the highlights of the program. It's a 12-month program. It's having 4 trimesters. The classes are conducted through online mode. 360 hours of it includes 360 hours of classroom teaching. The program is conducted through online mode with 2 campus immersion, and it offers 9 certification, 5 certification from NISM, which includes investor level 1 and 2, and 4 FPSB certification. Its core planning areas are investment planning, risk and estate planning, retirement planning, and tax planning. Other specialization subjects are securities analysis, mutual fund, fixed income, and ESG integration. The learning outcomes of this program is it masters the financial market structures and regulation. Through this program is designed for investment plans assigned with the client goals. It applies comprehensively to the risk and the estate planning strategies. It creates tax-efficient retirement income plans, and it helps to analyze the securities, mutual funds, and build optimal portfolios. We are having faculty with a great academic rigor and research excellence. We also invite professionals from the top financial institution who offers wide perspective about the SEBI and RBI regulatories. They include case study and the real world application through their teaching pedagogy. This program holds 2 campus immersion. Both the campus immersion are around 4-week long, and the campus immersion helps in networking with the SEBI officers, market professional. It includes the workshop on behavioral finance, leadership, communication skill. And during immersion, we provide the accommodation, dining, recreation facilities, etc. Then the eligibility for this program is minimum 3 years bachelor degree is required, and your overall profile will be marked. Plus, this course of personal interview would be taken into account for admission. Then the classes are generally scheduled on weekends, so you can do this program without disturbing your working hours. On Saturday, we are having 3 hours class, 6 to 9:15, and on Sunday, we are having from 10 to 5:15. 2 classes are scheduled on Sunday. The fee of this program is 3,18,000, which includes the fee of all the 9 certification as well as fee of 2 campus immersion. So the key dates to apply for this programs are the applications are already out from December 30 and they last till March 20th. The interview would be scheduled in month of April from 6th to 9th of April, and the classes will begin from May 16th onwards. The career opportunities through this program is you can be a financial advisor, you can be a relationship manager in the bank and advisory firms, you can be a wealth manager in private banking and asset management firms, you can be an investment advisor, research analyst, and it will also help you get into the insurance and risk management profession. So it's a dual value program. It offers the certification of NISM also, and it offers you the certification of CFP also. We are flexible with the online classes, and it integrates with the industry as well. So these are our photos. We have offered this program for very first year this time. So these are the photos from our immersion, and this is how we conduct our online classes. So right now these students are in their 4th term, and soon they'll be having their certification. So thank you, Sai.
Yes, thank you, ma'am.